Before I start this episode of our Grow It campaign, I want to say a quick thank you to the episode sponsors. They are Wealthify and Fidelity. I'm going to say a quick bit about each proposition, so make sure you listen to them, because later in the series, when I talk about the different propositions out there, they'll be useful to refer back to. Do remember that with investing, your capital is at risk, so the value of your investments can go down as well as up, which means you may get back less than you invest. That is relevant to each of the propositions I'm going to talk about. First up, Wealthify is a multi-award winning online and app-based investment service founded in 2016 and backed by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, £50 for pensions. Wealthify has a simple yet competitive annual management fee. Investment costs also apply, and offers a number of investment products, including a stocks and shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. For more information about Wealthify, including how to take advantage of our £100 cashback offer, please visit wealthify.com/MTTM. New customers only. Offer ends midday on the 28th of April 2023. T's and C's apply. Now, Wealthify does not offer advice. If you're not sure whether investing is right for you, then please speak to a financial advisor. Wealthify is authorised and regulated by the Financial Conduct Authority. Finally, I'd like to say thank you to our Grow It series sponsor, Fidelity International. Whether you're just starting out or an experienced investor, Fidelity offers a wide range of investment options with plenty of information, tools, and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. Before I start this episode of the Grow It series, if you've enjoyed it, please make sure you hit that like button, because it really helps our channel. Also, subscribe to the series, because you'll get the rest of the videos. There are 2 more after this episode. So please make sure you hit that like button and you tell other people about it. Now, by this point in the series, you now are familiar with investing and will have enough confidence, hopefully, to explore your options further. So for the remainder of the series, I want to briefly touch upon boosting cash returns, investing for children, and intergenerational wealth, and then investing for good, which covers ethical and impact investing. Now, you may have got to this point in the series and decided that investing isn't really for you, and that's okay, especially if you are risk averse and accept that inflation is likely to erode the value of your money over time in real terms. Or to put it another way, your money will be able to buy less of the stuff you want to buy over time. Now, cash is always seen as a starting point of any investing journey, but for some people it is ultimately a destination in itself, and it's okay for cash to be a destination if you understand the drawbacks. Now, in this episode, I'm going to run through some quick tips on how to boost the interest you can earn on money in a savings account. So firstly, it goes without saying, shop around. Don't just stick with your current bank or building society because it's familiar. Instead, compare rates from different providers to see who offers the best interest rates. Now, in the notes of this episode, I'll provide a link to our comparison table on the Money to the Masses website that's updated every week, which shows you the best interest rates you can get in the market. Now, I'm going to be referring to the notes of this episode a lot because there's some great resources that we've built that you can use to boost the rate of return you get on savings. Now, the second thing I would say you do is consider fixed rate savings accounts. Now, these fixed rate accounts or fixed rate bonds, they work by you agreeing to lock your money away for a set period of time, usually between 1 and 5 years. And in return, you'll receive a higher interest rate than you get with an easy access account. However, be aware that you won't be able to access your money during this period. So make sure you won't need it in the meantime. We provide links again in the notes of this episode to our best buy tables of the best fixed rate saving bonds out there. Thirdly, go and look at introductory rates. Some providers offer high interest rates for a limited period of time, maybe 6 months or a year. That's to entice you over. After this period, the rate usually drops, so make sure you know when that is. Put a date in your diary so you can then move your savings once again and perhaps get another introductory rate somewhere else, because if you don't, the rate in the account you choose will drop off after a year and you'll be stuck on a lower rate. It's probably competitive. So the next thing to do is consider alternative providers to main high street banks. Traditional banks and building societies aren't the only options for savings accounts, so make sure you look at things like some of the challenger banks out there that offer competitive rates. Don't overlook them. Also, don't forget to look at credit unions. A credit union is a member-owned financial cooperative that offers financial services to its members. So sometimes they can be related to particular types of employment or areas where people live. Now, there are approximately 500 credit unions in the UK, and like I said, they're community or work based often, and they serve around 1 million members. But some credit unions offer pretty attractive rates of interest on savings accounts. Also, don't forget to consider high interest current accounts. They often pay a higher interest rate on a portion of your balance. It could be up to, say, £2,000 if certain criteria are met. And these criteria are usually things like paying a minimum agreed amount a month into the account, and can also be that you have to pay a certain number of bills by direct debit from the account. So have a look at those. Also, look at regular savings accounts. There are some at the moment that pay as much as 7% a year in interest if you save a regular amount into the account each month. But normally, there is a monthly limit of a few £100s that you can save into those. I'll provide a link again in the notes of this episode to our best buy tables of these types of account. That's the high interest current accounts and also the regular savings accounts. Now, if the administrative burden of having to shop around is obviously a problem, it does mean you have to open up lots of accounts, and some of them you might have to go in branch. If that doesn't really appeal to you, then you can use something called a cash savings platform, which is a relatively new phenomena, which is a platform, an online savings hub that gives you access to a wide range of savings accounts from a range of banks and building societies, which you can use to maximize the interest you earn via a single website or hub. And it means that you, instead of having to have lots of accounts, you can have a single login, and a click of a button you can move your money between accounts. Now, examples of cash savings platforms are offered by the likes of Hargreaves Lansdown. They've got an active savings platform, and Raisin UK is another one. It means you can open one account with them on the hub, and you can move your money to different banks and building societies with one login. One thing to bear in mind, you won't necessarily always get the best rate in the market, although they have had some of the best rates in recent history, but it doesn't mean you're guaranteed to get the best rates. But you might prioritize the administrative ease, which still means you get a decent savings rate over getting the very best rate in the market. Now, again, links in the notes of this episode to a whole article comparing the different platforms out there. And this now brings me nicely onto the concept of a cash ladder. Now, instead of investing all your money into a single savings bond for, say, 5 years, to locking your money away for that 5-year period to get a better rate of interest, you could instead use a cash savings ladder principle, which is where you put your money in savings bonds, so fixed bonds of varying term, to achieve a better average interest rate and more flexibility in accessing your money. Now, the ladder involves investing equal amounts perhaps into fixed rate savings bonds of different terms and reinvesting the proceeds each year in a new bond of the longest term, allowing you to access a portion of your money year after year. And it might sound complicated, but it's a very easy process. I've put a link in the notes of this episode to a video on YouTube where I explain the whole concept and give you some examples. But it is a way of trying to increase your interest rates using fixed rate bonds, but not locking your money away for 5 years. As an aside, don't forget that everyone has a personal savings allowance, which for a basic rate taxpayer is currently £1,000. This means you can earn up to £1,000 a year in interest on your savings without having to pay tax on it. The allowance is reduced to £500 for higher rate taxpayers and reduced to zero for those earners in the highest tax bracket, known as the additional rate. So for most people, this allowance will cover the interest they receive on their savings, so they won't pay any tax at all. So it's important to remember that interest earned on savings accounts is liable to income tax. So you want to ensure that you are legally avoiding paying tax where possible. Now, some people can earn up to £6,000 interest without paying tax if they qualify for an additional allowance, which is known as the savings rate allowance. So I've put more info again in the notes of this video rather than dwell on it here. Also, don't forget to use your ISA allowance. That's the individual savings accounts allowance, which means you can put £20,000 each year into a tax-free cash ISA, and that protects all the interest you ever earn on that money from taxation. Now, the introduction of the personal savings allowance meant that many cash ISAs lost their tax appeal. But don't forget that the personal savings allowance could be removed in the future, meaning that all the money outside of your cash ISAs will then be liable to income tax. So I think there is still a very good argument for putting money in cash ISAs, even if occasionally the interest rates aren't quite as compelling. Finally, don't forget that if you are holding a lot of money at a bank or building society, you need to know how your money is protected if the institution goes bust. The Financial Services Compensation Scheme covers money held in regulated current accounts in the UK, and that includes current accounts, savings accounts at building societies and banks and credit unions. So this means that if your bank or building society goes bust and you hold less than £85,000 per person per banking license, you will automatically be covered and compensated. If you hold a joint account, the limit is twice the individual limit, so that means it's £170,000. Bear in mind, any money held over the limit will not be covered by the FSCS, so you may want to consider holding money over the limits with separate banking institutions. And bear in mind that it's about the license as well. As the FSCS limit applies per authorised firm, you need to check if these banks and building societies share a banking license. So I'll give you a good example of this. HSBC and First Direct share a banking license, which means that you only get covered up to £85,000 if you have money across those two banks in your sole name. So you need to check, and you can find out on the FSCS website if any banks or building societies that you have or plan to use share a banking license. So if you've enjoyed this video, you found it useful, please make sure you hit that like button, but also subscribe to the channel.